AvantStay's meant to be a hotel and a home experience.
Are you happy to share your direct booking ratio versus your third-party distribution ratio?
Absolutely.
So what are you? Are you in the hospitality industry or are you in the technology industry?
It's very rare when you raise $160 million and then 6 months later lay off 200 people, and it was a very difficult decision.
The OTAs have made property managers become lazy, and now they're paying the dollars for it.
In hospitality, it's really about building things for the long haul and enjoying the journey.
You are listening to STR Global Unlocked, brought to you by AJL Atelier, the show where I speak with the leaders shaping short-term rentals worldwide. I am Simon Lehmann, and after 2 decades buying, selling, advising, and investing, I've built a network that spans continents and categories. This podcast brings that network to you. Real conversations, global insight, no PR fluff. Let's get started. Today we have Sean Breuner, founder and CEO of AvantStay, on the show. AvantStay has become one of the most recognized brands in the short-term rental space and one of the most ambitious. Since 2017, Sean has raised hundreds of millions in equity and real estate capital, expanded across the US, and helped define what a hospitality brand at scale can look like. Today, we're going beyond the headlines, talking about growth, profitability, technology, and the tough lessons that come with building a national STR brand. Sean, welcome on STR Global Unlocked.
Great to be here. Thank you very much for the warm intro, and overdue for you, Simon, to have a podcast. So, very exciting. I think it's something that the industry certainly welcomes, and you're somebody that we've all spent a lot of time with over the years. So just wonderful to be here.
Thank you, Sean. It's great to have you as well as one of our big thought leaders within the space. Let's start at the beginning. When you started off with the idea of AvantStay, what were you trying to solve when you founded the company? And what was the thesis evolved that as the industry matured quite substantially as well?
Yeah, I think what we were trying to solve early days was how do we take an online world and deliver more offline experiences. So we always kind of looked at the business from an online to offline perspective, leveraging technology so that you could enjoy your life more. And then how do you ingest that into a consistent experience that brings people together? So everything that we did when we started this business, Simon, was really built around bringing groups of people together. So group travel. We always said, this AvantStay was built for the way people travel today. And taking a step back in time, the word avant is a French word, which means before. And it also, means stylistically advanced, ahead of its time. And so we love French hospitality. I think the French do hospitality incredibly well. And so just looking at the word AvantStay gives you a little bit of history into how we built the company. A company that, or a stay that was really ahead of its time, that was consistent, that was elevated. There was 4 groups. And then that transformed really into what we call today hotel and a home. So everything that you love about a hotel experience, bring into a home. Very simply put, AvantStay's meant to be a hotel and a home experience.
So was the brand aspect, Sean, always something part of the initial plans and thesis as well of building a brand? Or was that more about, obviously get the logic of Avant. Thank God I'm in a way Swiss and speak French as well. So we've learned that at school, but that makes a ton of sense. But was the brand aspect always part of the strategy to start with, or was it more a technology approach?
So always part of the aspect. I think, what we set out to build was a vertical enterprise platform that could enable a better experience for guests. We always look at everything as cheaper, better, faster. So how do you build a more affordable experience? How do you allow people to get there, make decisions faster, and then when they get there, it's a better experience? So the technology gave the front-end facing guests that ability. It gave the tooling for our internal operations to be more efficient and effective to deliver a better experience for those guests. And then obviously on the back end, homeowners end up reaping the benefits through higher ROI. As far as brand, we always felt that brand would drive loyalty and consistency and build a community of people both on the guest side and then on the homeowner side to help deliver scale across the entire business. And I think when you look at brand, it always takes longer to build, and everything is harder than you could have ever expected. Probably both technology and brand. Tech, by and large, is probably easier to build than a brand. It's more pragmatic. It's more, it's something that you can really focus and build a roadmap to build. Whereas brand is a bit more amorphous, and it's arguably one of the most challenging things to build in the world. And I'd say today we are still at the beginnings of what is a nascent brand, and we're 9 years into this. And I think it has been incredibly more difficult to build a brand that we could have imagined, but I think we're also in kind of the pole position to build something very special from a brand perspective. So the short answer is yes, 100%. We planned on building a brand, and I think we're on the verge of doing something very differentiated and unique there. And there's a lot of value to bringing a brand because of the different tangential offerings that you can bring into the community for both guests and homeowners.
Are you happy to share your direct booking ratio versus your third-party distribution ratio?
Absolutely. Yeah, I mean, we're happy to share anything, Simon. So I think, on our end, the direct booking's 35 to 40%, and that's by design. And the reason why we say that is because there were years when we were 45 plus. There's certainly markets where we're well above 50, 55%. I think the reason why we like 35 to 40% as a direct booking percentage is because we have partners. We have 60 partners: Airbnb, Vrbo, Expedia, Bookings.com, Marriott. Capital One is a large investor in the company. So we're the preferred villa provider for the 100 million cardholders at Capital One. You can use your Bonvoy points to book at AvantStay. Hyatt and Amex are going to be rolling out their platforms, or already have, and are starting to integrate with folks like ourselves. So I think we want to be great partners, and we want to feed all of the OTAs, and we want to meet the client where they are. And where the client is not always coming direct. The client might prefer to book on these other platforms. And we feel like it's very important for the ROI of our homeowners to be optimized across every platform, every distribution platform that's out there. And if you're 80% direct booking, you're not meeting all your customers where they are. And so we feel like a balance between OTAs is critical to the success of building a true platform and national brand.
Absolutely. And thank you for giving us that clarity as well. And we will talk about technology and distribution a little bit further in our conversation as well, especially the tech side is an interesting aspect that we're having conversations about all the time. What is the added value and benefits, and also valuation in terms of building proprietary tech versus using technology from the providers that are out there. Before we move on, I have from a starting standpoint at AvantStay, if you look back, what early decision most defined your path going forward, for better and worse?
For better, for worse, I think when you set out to build a brand and technology, it's incredibly expensive to do so. And especially with some of the recent marks in the industry of building a simple technology or more simplified technology. And there's been a number of recent acquisitions and sales that would substantiate building simple and user-friendly technology for the masses is a good thing. So on the software side, and then on the management side, not building a brand and isolating individual local companies and not integrating them has garnered, a lot of attention as well. So I think what we decided to do was shoot for the moon, and that comes at a significant cost of an investment. And we built a proprietary platform that probably 4 years in, we realized was going to be much more sophisticated and really kind of larger than we could have ever imagined in terms of the technology build. You have to build a full CRM, distribution, marketing, revenue management, field tooling, and automation, AI. So there's a number of different pieces, I think, that go into a full comprehensive platform to disintermediate the point solutions, not to mention the integrations from those point solutions that give you that efficiency. And sometimes, you want to buy versus build. And that's always the question in any of this is, do you buy or build? But what we built is an opinionated platform that I think today is enterprise in nature, and there's nothing that exists on the open market. And we demo these platforms consistently to fit 3,000 luxury properties growing at 30% plus, that is going to deliver a 4.85 rating across 60 different platforms. And that's been kind of solidified across the industry. Nobody's done that before. And I don't think that we would have been able to do that or got anywhere close to doing that without, the hundreds of millions of dollars that we poured into the platform to build something that is truly enterprise in nature. And when I say enterprise in nature, most of what exists off the shelf or even the franchise solutions is either a tech stack that brings in third-party solutions to build an enterprise system, and it's not all under one hood, or it is a PMS, a property management suite of products that's built for the individual local or regional operator that allows you to get to maybe 500 to 1,000 properties, and is not going to be opinionated in nature. And a lot of times these things break, Simon, once you get to a certain level. And we've seen this with a lot of the competitors that have not made it out the other end, that have scaled and given up quality. We've actually increased our NPS and our scores across every OTA every year in business. And now we're in the mid 4.8s with 150,000 reviews. We're the highest rated national manager in the country, and it's not close in terms of the quality that we've been able to show at scale. And I think that's the better or worse. Is it costs a lot, it takes a long time, but the better is if you make it through that, you have something that's very powerful and you get some of those economies of scale.
So what are you? Are you in the hospitality industry or are you in the technology industry?
I think we built a platform that is backed by what is a burgeoning brand in the hospitality space. So I would say we built a hospitality platform and brand, but ultimately it's a hospitality company. And I think, on the technology itself is what allows us to scale the brand. And so every company these days has technology. We've now layered in AI into almost every part of the business, and it's becoming very exciting. But technology, I think, is a core ethos to everybody's, kind of platform capabilities or brand capabilities. And we just happen to build it ourselves, and that gives us a lot of agility in the space.
Is Marriott still using Oracle or Opera? Like, how does that differentiate in your view?
Well, I think the hotel industry, they use a lot of different technology stacks. Some they actually require you to use a specific third party. I think it's Hyatt, has their own technology or has a third party stack. And I don't quote me on that necessarily, but each hospitality company has a number of different brands, some of the largest ones, and they use different technology stacks. Very few of them, if any, have true proprietary. But I do think the hotel industry is completely different than ours. And so I'll explain. So vertical operation means you have boots on the ground all day, every day. And so to run a 200 unit hotel with a vertical operation, you need less technology than running a horizontal operation. A horizontal operation, I have 200 homes across a 50-mile radius, and I don't have a single person on site at the home at any time. And so part of our thesis was always that technology matters because in order to run a horizontal operation, technology is absolutely critical to deliver quality at scale.
Yeah, I mean, this is a super interesting conversation, especially what drives value. And we might get to that as well in terms of the investment as well. We've seen other companies in the STR space, such as Vacaso, have invested huge amounts of money in building their technology to position themselves as a technology-enabled property management company. Now, everybody walks away from proprietary tech and says there's enough stack out there to help us to do the right thing with what we need, and then really focus on the guest experience and the owners and everything else. But we'll cover that a little bit later. I want to talk about...
Can I say one thing on that? Because I think it's super important. So you said the guest experience and the owners. So when we started the business, we started it purely about the guest experience. And we started it by leasing properties because we didn't think that we could attack the guests and the homeowners at the same time. We didn't think that we could, maybe a different word would be support the guests and the homeowners
Yes.
at the same time. And so we did not. And so the strategy was, if you lease homes, I don't have to talk to the
Yes.
homeowners because they're getting their check every month. And that worked really well in the early days because ADRs and RevPARs were increasing 10 to 20%, and the leases were performing. We then always had the strategy of shifting to a management fee once we had the data and we could show that we could perform at a higher level, both in terms of quality, but in terms of performance. And so what Vacasa did was they started with their homeowners and they built all the tooling and support for homeowners and neglected the guests. We started with the guests and then shifted to the homeowners. You could make a case that we shifted there a little too late, but if you make the guests happy, they're going to pay more money. The reviews are going to be great, and then the homeowners are going to be happy by default. And so I think that was the difference, is starting with the guest and feeding to the homeowners, who's arguably the most important stakeholder, but the only way you can make homeowners happy is by delivering a great guest experience.
Yeah, absolutely. And good income on a regular basis as well. That doesn't fluctuate too much. So let's talk about scale and operational reality. I mean, you raised 160 million in Series B and later another 500 million in a prop tech fund as well. That's significant, a huge bet on both operations and real estate at the same time as well, right? And what worked and what didn't in looking back at the capitals you've raised. And I once say went through multiple rounds of layoffs in 23 as well. So you had to face some challenges. What's macro pressure or structural reset? Was it more structural reset or was it general macro pressure as well?
Yeah, good question. So I think end of 21, December is when we raised that. And then 6 months later, we did a very large layoff. So all of our layoffs were really in middle of 2022 to end of 2022. And we had raised, like you said, a $500 million fund. We had also raised another larger vehicle. And rates were 0% in January of 2022. And then in April, they started hiking rates, and we started seeing macro pressures. Inflation went to 9% the summer of 2022. Supply chain got choked up to where you couldn't even order furnishings, and things didn't get delivered for 8 to 12 weeks. So we had designers and agents in PropCo and onboarding. We had all of this support that was built to acquire real estate at scale and support onboarding at scale. And then the whole world kind of changed overnight. And so I think the macro pressure of that, we were one of the first companies to start laying off. And we were probably 12 to 18 months ahead of any other company doing it. And I think that was the right call. It's very rare when you raise $160 million and then 6 months later lay off 200 people. And it was a very difficult decision. It's never fun.
Of course.
You kind of, you have to do it for the right reasons. And I think for us, it was, we could either power through this, burn a lot of capital, and try to grow into our headcount, because the first 4 months after raising a large round, you build up infrastructure, human capital infrastructure, technology, platform infrastructure. So we spent 4 months building that up, and then the whole world changed. We'd also acquired a number of companies. And if you remember back then, the multiples for the companies were starting to increase in a very significant way.
The buyer's market, right? Seller's market, sorry.
Simon was right in the middle of all of that, representing a lot of companies. And we decided to pull back and pause. And so we went from growing at 2 to 3x to growing very slowly or steadily, I would say slowly compared to that. And we didn't need that amount of headcount. And there were divisions that were not going to be, successful in an environment when you have 7-8% interest rates for short-term rental, for short-term rental propcos. So we made a decision really to kind of, fold a lot of divisions. We also were getting much stronger on the technology side. And so we got much more efficient across the board. So the idea was, do you grow into a 900-person headcount company, or do you find a path to profitability, which is what everybody's asking for? And obviously we're profitable today, but do you do that through some combination of growth and right-sizing the company for the current macro environment? We decided the latter was important. And I think we did so very quickly. And sometimes you have to make decisions, much faster than you'd like to. The goal was always to grow into a headcount ratio that made sense. We just had to do it much faster because of the macro backdrop and the headwinds that were very apparent. I mean, when you start seeing rates go up, you know that it's going to take 2 or 3 years to recover from that.
So that leads me straight to the next one, in terms of balancing the investor expectations, right? So margin versus discipline, and obviously raising that much capital, that must have been pretty challenging. And we have a lot of listeners in our audience who are, obviously smaller type of organizations looking at the AvantStay model. Like, what would is your advice and your learning from, balancing investor expectations and then looking at discipline on one side and margin on the other? That must have been very challenging as well.
I think it's not always, a mentor of mine very early days gave me some advice, and he said, it's not always about building it first. It's about building it right. There's always a first mover advantage. And he was the CEO of DocuSign, and DocuSign was not, the preeminent digital, signing platform, e-signing platform. It became it because they built the best technology and the best platform, the best brand, the best team. And I think it's really important to build the best product. And it's not always the most important thing to do it the fastest or to be the first out the gate. You could even look at Apple, right? They were the second mover into that space and became, a better product than Microsoft, although Microsoft now, has arguably surpassed in some ways. So without getting into the Apple Microsoft debate, the idea here is that yes, it's challenging, but doing anything when you're trying to build a global, national and global company within 10 years. I was just reading something the other day. We're a fairly sizable company in the hospitality space, and Rosewood took 40 years. And I was reading the article, and Rosewood, they were kind of characterizing it as a very young company in hospitality. And how many years did it take to build Marriott to get to a certain scale? So I think sometimes we forget in hospitality, it's really about building things for, the long haul and enjoying the journey. It's not about the destination. We're not in this for a quick hit. We're in this for, we always say over here, we say long-term greedy. That's kind of how we look at things, is we want to stay long-term greedy. We don't want to have a short-term horizon. And I think it's critically important to kind of have that in hospitality and enjoy it, because it's a really hard industry. So balancing, I think, that long-term approach and not being, overly impatient, and having some perspective about why you're here, and then, kind of relaying that to investors is probably, a reasonable approach.
Yeah, I love that. I love that analogy as well. And your example about DocuSign. So AvantStay will become DocuSign short-term rental. I love that too. And I think the timing that it requires to build sizable brands. And this was an interesting aspect that I wanted to allude to earlier, to one of my questions. One of the things that we're debating a lot within the STR, global network and thought leader conversations that we're having, is that so far nobody's been really able to build a consumer-facing brand within our space at any shape or form, with the exception of some of the old European operators who either are UK-based, who are in a domestic market, demand supply in one country that has been around forever. Old brands like a Sykes Cottages, like a cottages.com, like a Host Seasons, they still see 70-80% direct demand, but they're brands that have been able to build that over a lot of time. And if you look at Novasol, Interhome in Central Europe, these brands, Interhome was founded in 1965. That took a long time to build that brand to that level. But if you look at the US and some of the examples like a Casagova, Casa, Vitreps, and other large players, even an Away Days, who put brands together, it's very hard and it takes time, to your point, to build a consumer-facing brand and bring people constantly back.
But I guess, why do you think on that end, Simon, do you think that those guys didn't build brands versus maybe where some of the other companies have an opportunity to build it? Because I think there's one very important reason why. I guess.
I mean, it's a balancing act, right? I say OTAs have made property managers become lazy, and now they're paying the dollars for it, right? So it was
I
extremely
love that. I haven't heard that. That's interesting.
yeah. So it's become super easy to create demand. So why do I care about demand? Because it's coming from all the big four. And then all of a sudden they're cranking up commissions. I mean, when Airbnb announced going 15% with no host, no guest fee anymore, everybody was up in arms, making calculations. How is that going to cost my distribution costs? Booking.com is such a powerful machine. I have a lot of respect for Booking. But at the end of the day, if you're not thoughtful of how you're building up your distribution strategy over time, you're going to become, you know, you become dependent on these OTAs, and they will crank up the commission to a level where it's going to make it very hard, and margin compression will evolve, et cetera, et cetera. And we've seen margin compression now over time as well. So I think I reduced that somewhat to a laziness as well. It's been too easy to flip a property onto one of these platforms and create enough demand without having to worry about. But obviously, guests get more sensitive as well. Owners want a certain return, so the property manager is now being squeezed out, and I think that is a huge threat to our industry overall. And yes, OTAs have invested billions and billions. I remember a number in 2019 where the large four OTAs in the world invested 21 billion into Google. It was insane, right? Just to create demand. And that's something that we're now paying the prices for. These brands have become massive. We'll think about distribution. I've talked a lot with guests on my podcast about how distribution is going to evolve with AI and different consumer behavior in searching. This is going to be interesting how this is going to ball out against the OTAs as well. How do they play with that? I mean, my kids don't even use Google anymore. They don't know what that is. They use ChatGPT for everything they do in their lives. And
Yeah.
doing these type of searches nowadays.
Gemini, though, I will say is getting very powerful, and I'm a big believer because Gemini is integrated into everything that
Yep.
we do, from Gmails to Sheets to reading legal documents and summarizing them for you in seconds. But I think that you touched on something that I agree with 100%, which is the laziness piece. And that is the part about hospitality is you can't get complacent, you can't get stagnant, you can't build commodified product. And so if you remove the laziness, which I think is the best way to summarize, what we're referring to, you start to now take on any product you want. And so going back to the question, which was, why were those guys not able to build brands? They started to build a hodgepodge and together a product that was inconsistent. So,
Yeah.
and then that product, you don't want to sit your $3-4 million home next to, something that might not be the same quality or that might not deliver an experience. And so then you damage your reviews, you damage your supply, you damage the brand. And so I think one thing that we've been very prudent about is staying in the luxury segment. And keep in mind, it's affordable and attainable luxury. So our average nightly rate is about $900, $950, and the average number of people, 7 people, and you're staying in a multi-million-dollar property for $130, $40
That's
a
a good
person.
gig.
That's what our site, it says per person, because the price is incredibly cheap, and you might be on the beach, then 4 blocks off the beach at a 4-star hotel, which is $500 a room. So I think that laziness piece is really important, and staying true to who you are. So for those, they're thinking about building brands, don't just take properties to take properties. Stay consistent in the segment of the market that you want to operate. And I would argue that it's actually easier to build a brand in the luxury segment than just building it for scale. And so then that also drives what we call willingness to pay. And it's an inelastic segment of the market. And so what I mean by that is people's willingness to pay for a superior experience is incredibly inelastic, and you're not competing on supply, you're then competing on experience.
Yeah.
And you want to compete on experience, not on price. And so if you have the best experience, usually there's somebody who's willing to pay a higher price for it. And then, of course, you can start to layer in ancillary amenities and services through concierge, whether that's chefs or stock fridges. And so we've always felt like the best way to build a brand is stay true to who we are, which is groups and larger form factor and kind of inclusive buildings and luxury and premium. And then you can layer on all of the services that then differentiate you in a very significant way from the other operators. And I think that that's where we've won a lot of business, a lot of supply, is staying true and then building a product around the product. And the product around the product are all the services that you get when you stay at AvantStay. And now an AvantStay home is generating 20% more revenue because somebody has the ability to have all these concierge and amenities. And we always use that analogy of, if you look at the beach in Oahu, there's a Four Seasons and then there's a Grand Wailea. The Four Seasons is $1,500 a night. The Grand Wailea is $500. It's the same beach, and the hotel rooms are almost exactly the same. The only difference is the amenities and services that are offered at the Four Seasons drives the price to 3x.
Never missing an opportunity to position AvantStay. Fantastic. And I totally agree with you, Sean. Obviously, that's what you do with all your heart and passion in the industry. If I stay with AvantStay with my 5 children, I still have to pay the full bill, right? So for me,
we'll have a discount code for all the listeners at the end. How about that?
Anyway, let's move on and talk a little bit about I have one more in terms of your running your business. What is your most important metric that you look at every day before you even get a coffee out of your coffee machine?
Yeah, I think so. We've always said it's a front-end local, back-end institutional business. And that's another kind of area that I'd say is really important in our industry is to really, have operating leverage at a local level. And so we always look at things from a performance management at a local level. And so we look at every single market's NPS. And if you have a great NPS for a guest, that usually means you have great reviews, which usually means you have happy homeowners, which usually means you have low churn, which usually means you have good growth. And so if you have a incredible guest experience and high NPS, it makes the rest of the business work. And that is a very simple kind of way of looking at things. But obviously, I think if I wake up every day, which is what I do is I look at the market level NPS of every single market in the country. And that to me drives is a lot of insights in a snapshot.
Without a doubt. And that's a great example as well, such as, Sykes Cottages, Graham Donoghue Young, that talks about NPS. It said, if I can have my staff and my team improve my NPS, my commercial results and satisfaction of staff and everything goes up at the same time if you integrate it the right way in the way you look at NPS across the business, guest-facing and also owner-facing. I want to talk to you about business models as well. I mean, that we had a lot of debates that, we've seen now. We're seeing our franchises on the rise. We've seen the business model of Casa not being as successful as anticipated due to, probably not having the right unit densities within regions, making operational efficiencies, investing a lot of money into tech. And we talked about that. I still have my question, value from proprietary technology versus using technology that is out there. In your case, you made that point very clear. That's a very important driver for your business overall. Does not necessarily engage with your valuation as a business as well, because you're in the hospitality industry and you became asset heavy at the same time. So how would you compare that? And is the asset heavy aspect now of AvantStay drawing a lot of your attention than versus other business models that are out there, like a franchise and business models that we're seeing evolving very rapidly within our industry?
Yeah, I think it all can work. It just depends on timing and access to capital. So, and there's 3 levels there's many levels of asset light to heavy, but there's management fee, which is, asset very, or actually there's OTA, which is asset incredibly light, which is, then there's, at management fee management, asset slightly heavier, but still light. Then there's lease, which is asset light. When we started the business, we called it asset light versus ownership. And then ownership is the asset heaviest, right? And that you're subjected to kind of, the macro at that maximum degree. And I think, they can all work in an environment where ADRs and RevPARs are up to the right. You're better off being, owning leases than you are in management fee, because your margins will increase in a world in which, you have stagnant ADRs and RevPARs and you have 3 to 4% lease bumps. Then you start to get into trouble. And I think that's what's happened in our space for those that master lease. What I would say is that if you can build an asset light platform and drive, brand and accretive value, that's always going to win in a more meaningful way versus leasing. Because even if you go back to our conversation about laziness, you can get lazy with a lease because you're
Yeah, of
not
course.
to building a true, management fee platform and brand and sharing in the upside. And so we always look at asset light as alignment. And we told our owners this from day one. We want to be aligned with our owners. We want to win together. And when things are not going as well, we're both going to be somewhat penalized from the broader macro and demand trends, but at least we'll be there together. And we don't want, that misalignment. So I think that the asset light nature of a management fee platform and business model creates a deeper sense of alignment with your stakeholders that I think allows you to be successful. And if you look at all of the hotel companies, and we've studied them inside and out, they all moved to asset light. I don't think a lot of people know this, but Marriott doesn't own any of their buildings, right? Marriott
They own
is
6 hotels from 6,500.
okay. There we go. 6 out of how many? Right, less than 1%. And it's a franchise platform. And then the only ones they manage are, I think, St. Regis and the Ritz, only the super premium luxe product. So franchise is even a lighter, business model than management fees. So I think if you can go as light as possible while maintaining the brand and value proposition, you could argue that Marriott, his value proposition is Bonvoy. That's where most of the value of the business exists, is in loyalty.
Yeah.
And I think over time, there's a lot of opportunity in franchise and loyalty platforms. And we talk about it all the time. And I think we'll be rolling something out soon. This is the first, folks will hear about it, but over the next kind of 6 to 9 months, there'll be something very compelling, for folks that use AvantStay frequently. And yeah, all of the multiples for the hotel industry shot straight through the roof once they move to an asset light model. So I think that is where you want to be, but you have to earn the right to be there. And it's not easy.
Yeah, it's very challenging. I remember at an LP conference, investor conference at Thayer Venture in San Francisco, when Rick Hoffman, the former head of corporate biz dev at Marriott, asked Francis from Sonder, how do you sleep at 300 million committed leases on your balance sheet, right? So
the writing was on the wall after WeWork. That master lease, 10-year master lease model was not a good model. And there's ebbs and flows, and you don't want to be taken out during a downturn. And I think another piece of advice that I got was every year can't be your best. And it's like, it's every year can't be your best. You need to prepare for, not everything goes up and to the right. And so you need to prepare for those days. And I think, more importantly, when things are going well, to not be overly greedy and the margins will be higher on a lease when things are up to the right, but creating deep alignment with homeowners and focusing on how you can build a better experience and drive supply for that alignment and use that data to increase supply is a better business model than the asset heavy version.
So we be mindful of time, and we have another topic I would love to touch on is outlook, consolidation, and regulation. So how do you, let's, Sean, you and I look into the crystal ball a little bit. Where do you see regulation sit from where you're at AvantStay, and how is that going to affect our business overall?
So regulation, I think early days was a huge concern because it was a black box. It was, at best it was a gray area. Sure, there were a few cities that were able to define some of their regulations, but you were in the midst of things being shut down. Look what happened in, even we just touched on Sonder, but Boston, they went in there and it was amorphous, and all of a sudden they lost, hundreds, if not thousands of units. New York, they just had, it's always been illegal. And we never touched or went into New York for that reason, because why would you go somewhere that is unknown? It's not worth that risk. That being said, I just got back from Airbnb, and I met with, some of the folks over there, and their chief legal officer is incredible. And he's on the offensive, and he has called regulation of property rights unconstitutional. I tend to agree with him. And I'll quote one of his stories, where he said that George Washington, our first president in 1789, rented a home in New York City when he was being inaugurated from John Adams, the vice president, and he didn't want to stay in a hotel, right? He wanted the luxury and comforts of a home. So the rentals of homes have been happening since George Washington, the first
a
president,
lot longer even that.
and a lot longer. But it's in our constitution. It's unconstitutional to rip the property rights away. Now, there's obviously balance and enforcement, and there needs to be rules. And we are big fans of regulation.
I love it.
Just not a full control of property rights. And the reason we're big fans of it is because if you look at Scottsdale, demand was up 45%. So you think the market was doing incredibly well, but supply was up 55% over that same 2-year stretch. And so you saw the returns of those homes go down. And so you always want to look at where demand is outpacing supply. And from a PropCo perspective, you only want to invest in my opinion, in regulated or well-defined regions, because you're looking at property level economics as opposed to total demand. And sometimes people look at the industry and they go, is it doing well? If demand is up across the board on in aggregate, it just so happens that your house is down because there isn't well enough defined enough regulation. And so there are markets that have seen some compression in RevPAR, where there's markets that are highly regulated, and you've seen actually expansion because total demand is up and supply is relatively constrained or at least regulated. So big fans of regulations, big fans of what Airbnb is doing to now go on the offensive and drive results. They just won and overturned South Lake Tahoe, which we're now moving into. South Lake Tahoe has been illegal for years. They just overturned Las Vegas, or in the process, I think, of doing it. Not a big win there. So there are, and this is all public information, there are, tens or hundreds, you might know better than me, Simon, of national in the U.S. and then global lawsuits that Airbnb is driving to win on behalf of hosts. And I want to give a shout out to them because I really think that they're starting to make waves in hospitality in our space, and they're going out there and spending their money on behalf of hosts like ourselves, individual hosts, pro hosts, and they're taking the lead to really earn back, property rights, but do so in a well-defined and regulated way that I'm very supportive of.
I think that's a great statement, which I can only support. We at STR Global Unlocked, as well as AGL, we're all for professionalism within the STR industry. So we're embracing, we need to embrace regulation. We don't need to fight it, because we need to raise our standards and our quality and everything else as well. There's not enough, there has been too much space for cowboys. The entry barrier of people coming into our industry is extremely low. So, regulation is not just a bad thing, as you said. It's actually a very good thing also to help us to professionalize as an industry. And it's not about fighting regulations. It's about embracing it and try to raise the bar and the quality and everything else, right? So is it like,
I think that your point, and you've always been a steward of that. Like, you've always said that from the first day we met. It's not about a lack of regulation or it's about having the right regulation, and we always say thoughtful regulation.
Yeah,
like, let's get regulation in place that highlights the best managers or the best operators, because if you do that, then I think all the stakeholders, from the restaurants to the shops to the communities, like, how nice it is that I can have my family stay down the street from my house. There's no hotels anywhere, and they can rent somewhere, and we can all stay close together when they're visiting in town. That's a beautiful thing for me, but I also don't want a party house down the street. And let's regulate out the operator that isn't, that's allowing that. So I think, and Simon, you've always said this from day one, that, like, let's have regulation and we love it and let's embrace it, but let's make sure that it's thoughtful.
Is the market going to consolidate, or do we continue to be fragmented across the world in terms of supply and management?
Yeah, it's the largest, most fragmented industry in the world. $200 billion plus revenue industry with 23,000 short-term rental managers in the U.S. alone. I don't know how many.
144,000.
Yeah, and that's probably
20 plus.
That's probably light. I mean, those are reported. Those are legal ones, right? Those are ones with actual broker licenses. But I think, there's a lot. And so I think, without question, the recent transactions in the space have highlighted the fact that it's a massively fragmented space, and there's huge benefits to consolidation. especially from a multiple and valuation perspective. So you're starting to see private equity money pour in. You're seeing more deals happen in the last 8, 9, 10 months than have happened, ever, I think, in the history of our industry. And for 2.5 years, it was stagnant. Nothing was happening. And then you go back to the 2020, 2021 days, there was obviously a lot of action, post-COVID.
So is it going to consolidate?
Yeah, it is.
Okay.
Definitely.
Listen, we're literally up. Sean, you and I could talk for hours, and it's been super interesting, and I really value your input here. Before I let you go, we're wrapping this up with a quick rapid fire, and we have not rehearsed these questions in any shape or form, but it's very straightforward, and you give me as short an answer as you possibly can. You ready for this?
Shoot.
Growth or profitability?
Profitability.
OTA partner or necessary evil?
OTA partner.
Most overhyped buzzword in short-term rental?
Regulations.
Biggest blind spot for operators?
Expenses.
Regulation, threat or catalyst?
Still a catalyst.
One competitor you admire?
Natural retreats.
One decision you would undo?
Building too early. There was one. I was supposed to one word, right?
That's fine. Building too early. We'll let that go. AvantStay in one word.
Premium.
Been a great pleasure, Sean. Thank you so much for running us through that. Your insights, your transparency, and your view about the industry has been super interesting and thoughtful. We want to thank you for joining STR Global Unlocked.
Thank you, Sam.
That was STR Global Unlocked, where we say what others won't. If you got value from today's episode, send it to someone who is still playing it safe. Follow the show and get more global insight at ajlatelier.com. The globally recognized STR consultancy I founded and that proudly brings to you this show. More bold conversations are on the way, so stay tuned.